This week, we're asking the question, are dividends part of sellers' discretionary earnings? I'm going to show you if they are or aren't, and a better way to take a look at addbacks and adjustments to make sure you don't fall into a very deadly buyer trap.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, I got a really fantastic question that was submitted to me over Twitter by Corey. Let's take a look at it. He says, you did a video with Elliot Holland that discussed SDE and how dividends paid to the owner at the end of the year are not part of seller's discretionary earnings. Anyway, can you provide a short video on that explaining the reasoning that paid dividends are not part of SDE? And then he follows up by saying, I'm seeing a lot in SDE valuations. I think this is great because it is a common hazard. In fact, I made a video years ago about a double counting trap, as it were. And I'm going to show you the type of broker or seller presentation that often leads to this very problem, and a way that we can better look at income statements to make sure that we do not make this kind of error of double counting any money. So let me start off here by sharing my screen. So this is the video that that Corey was talking about, due diligence and quality of earnings reports with Elliot Holland. This was a live stream on my channel, March 31st, 2023. So you can find that by heading over to the channel and just looking at the live streams, or just search it up. If you search David Barnett, Elliot Holland, due diligence, it'll probably come right up. So the common format, and here I'll put myself beside this here. The common format where you're going to see this kind of problem is going to look like this. So you've got an income statement, or P&L, some people call it, and you can see you've got sales, cost of goods sold, your gross profit. Then we have a whole bunch of expenses here, amortization, wages, travel, telephone, utilities, rent, et cetera, et cetera. We have our total expenses, and then that gives us our income once you subtract the total expenses from the gross profit. And then we have a couple of, sort of non-operational adjustments here, income tax and the loss on some sale of assets. And it gives us our net income, in this case, $131,325. So then, and I see this a lot too, Corey, a lot of brokers will show the P&L, and then at the bottom, they'll have some kind of add back list. And these are the things that are being added back to the net income. And these are supposed to represent other money that the owner gets to benefit from, or non-cash expenses that are just on the P&L for tax purposes that actually add to the overall actual cash flow of the business. So I've got them down here and I've footnoted them. And this is a completely fictitious example that I made up, but it's all based on things that I've seen all the time. So in the cost of goods sold, they want to add back $5,000 because they say it was for lumber to build a deck at the owner's house, right? As small business stuff, people sometimes do this sort of thing. Amortization, the definition of EBITDA is earnings before interest, taxes, depreciation, and amortization. So amortization gets added back. And seller's discretionary earnings is EBITDA plus adjusted with the owner's salary. So I've got a really fantastic video called "Why SDE is Not Cash Flow" that you may want to check out if you want to fully understand the concept behind seller's discretionary earnings. Then we have wages here, and we've got a $100,000 add back for owner's wages. So what does this mean? It means that in this entity, the owner is on the payroll and is actually being issued, a tax slip for earning an income, and the company is withholding source deductions from this person. So they're saying that part of that wage expense of 250,000, 100,000 went to the owner, and so it's part of SDE. And then we've got some travel, some vehicle expenses which are being claimed as personal expenses. Interest and income tax are being added back because again it's part of that EBITDA formulation. And then the loss on the sale of assets, they're saying it's a one-time event, not material to the regular operations. And then they're saying that there was a dividend of $50,000, and this was a benefit to the owner of being the owner of the business, and that this then is part of their cash flow, right? So the total is 251, and we add that to the net income, we get $383,300 as the total SDE. So here's the problem with this kind of presentation, is that the term add back or normalization literally means we are adjusting an expense to show what part is not material to a new owner. Okay. And so I would question you and ask, where in the P&L is the dividend expense? Right? And you can't find it. And that's because dividends are not a P&L or income statement activity. So where do dividends happen? Well, let me unhide some rows here, some columns. Unhide. Welcome to the balance sheet that goes along with this example company, right? And so on a balance sheet, and here I'm going to zoom in, make it a little bit bigger. On a balance sheet, you've got two sides. You've got the assets over here. So we have some current assets, cash and accounts receivable, $200,000 of cash and $50,000 of AR. And then we have a truck and some equipment. And our total over here on the side of the assets is $460,000. And then over on the liability side, we've got some accounts payable, we have a credit card balance, we've got a bank loan, and the total liabilities that add up to $255,000. And then we have the equity of the company. So we've got a nominal amount in here for share capital, $100. And then we have retained earnings, $204,900. And then we add the equity, and the liabilities add up to $460,000. It balances, same as the assets. And that's why it's called a balance sheet, right? So when an owner of a business takes a dividend, what are they doing? They are taking out part of this equity, part of the retained earnings, right? So I've got this thing all set up to automatically adjust when I make an adjustment here. So in the case of a dividend, there's $200,000 in cash in the business. The owner says, I'm going to take out $50,000. So I'm going to put negative $50,000 up here in the bar, and I'm going to hit enter. And what's going to happen is now our total assets are only $410,000. And you can see the retained earnings have fallen as well. And so they have also fallen by 50,000, right? Because what's happened is the owner has taken $50,000 of cash out of the company. He's withdrawn some of the equity of the business, in this case, part of the retained earnings. Now, where do earnings come from? Where are the retained earnings generated from? Well, they are the net income, right? As the business operates and the P&L shows net income, any net income, this represents gains within the company from operations. They are the retained earnings. And so the reason you can't count dividends as part of the seller's discretionary earnings is because the dividends come out of the money that's already being counted in the net income, right? And so if you were to add the dividends back, you'd be counting the same money twice. And so this is why it's a trap for buyers, because if you're not aware of this hazard, you end up valuing a business based on an inflated SDE, which is double counting part of the dollars that end up in the hands of the owner. So how can you avoid falling into this trap? Well, it has to do with the way it's presented. So I'll show you my preferred way to represent adjustments and add backs. I'm going to unhide some more columns, is not by putting the add backs down at the bottom, but rather by representing these things side by side. So in this case, I've got exactly the same P&L or income statement for the sample company here. But then I've added a column called adjustment, And I've basically gone down and put all the same Addbacks in, except I'm putting them beside the expense lines that they belong with. So our $5,000 of lumber appears right beside the COGS and adjusts the cost of goods sold to $395,000. So this increases the gross profit. And then for the amortization, the wages, the travel, etc., each of these things is itemized right beside the expense line that it belongs to. I'll make it even bigger, right? And so in doing it this way, we can actually see each specific add back and how it relates to the income statement item that it's adjusting. And when you do it this way, it becomes very clear that there's no place to adjust dividends. It's just not on here. And so in this sample normalization, we end up with the seller's discretionary earnings of 333,300, whereas in the previous example, it was totaling 383,300. It was overstated by 50 grand because the broker or the seller had tried to add the dividends as part of the add back. Anyway, thanks for the great question. If you are buying a business and you want to learn more, sign up for my email list. Take my online course, Business Buyer Advantage. I've got all kinds of resources to help you learn and to avoid silly mistakes like this one. And believe me, there are buyers out there who have overlooked this kind of thing and unfortunately haven't had the team of advisors around them to help catch this kind of problem. Even worse is business owners who work with brokers who lack a fundamental understanding of accounting and make this kind of mistake and overinflate the expectations of the seller, making them believe their business is worth a lot more than it really is because they haven't been able to figure out how to calculate the seller's discretionary earnings properly. And those are really sad cases because usually when a business goes up for sale, it's because the owner needs to move on to something else. Like they need to sell the business because they're moving on to something else in life. And if they end up in a situation where they're trying to sell a $300,000 business for $700,000 because the broker tells them it's worth that amount and they don't know any different, they can wait years and never get an offer. And when they do get a reasonable offer, they don't know it's reasonable, right? Because calculation wasn't done properly. Anyway, thanks for the question. Keep them coming. And if you've seen this before, or if you've got any kind of commentary or feedback on this kind of problem in a SIM or business profile that you've looked at as a buyer, put it in the comments down below. Other people would love to see the comments. I'd love to see the comments and hear your stories as well. And with that, I'll say see you later. Have a great day.
So, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.